Hi back everyone. Welcome to this lesson. This is part 3 of market cycle and transition. So as we talked about, market cycle is a combination of market structure and momentum of market structure. So market structure in our trading time frame is exactly the leg momentum in higher time frame. So for example, if this is 15 minutes time frame, so if you go to 4 hour time frame, you will see this as a leg, and there we have leg momentum as we talked about it in the previous sessions. So you can identify momentum through last leg of our structure in our structure time frame, and or you can come to break that down into swings, and you can just measure the momentum using this uh, actually slope of the uh, trend lines that they're coming down or up, and or also you can use moving averages to gauge how fast or how strong a movement is. So here you can also check overbought or sold area using swing ones, and even you can do this in a higher time frame based on candle and candle retest and so on. So, but swing view is much more accurate, and you can be more confident. So now, from the last session, if we continue, today we're going to break this leg, last leg, which is our structure's time frame, last leg, into swings. Here, as you see, we talked about this yesterday. So here, if you're just selling, you're going to be happy. Now, not only we are just learning how to identify the end of pullback on in higher time frame, which is the last leg of our structure. After we're breaking it down into trading time frame, you can use the same concept when you want to just get into the trade. Before you do that, as I said, the very first step of anything is that you have to identify your market cycle. Our market cycle were trading range, wide range or wide actually channel or weak channel, let's say, a normal channel, tight channel, and finally spikes or breakout phases that they're very strong. Now, here we have a kind of normal channel. Okay, here we have a normal channel which has like 2 or 3 candle pullback. So this market cycle is uh, market cycle between normal channel and a tight channel, but I consider the normal channel. If you just consider this pullback and you connect them together, you'll see that we're forming a trend line, although you're not supposed to use trend lines to trade, but trend lines are crucial aspects, crucial tools that you can use to identify your overbought or sold areas. As I said, it is not for entry. It could be used as the breakout, actually trend line as entry, but you cannot use trend line touch to trade, because at the end of the day, you're going to be a losing trader if you don't know how to use it. So here, if we just consider candles, here we have pullbacks, it goes down. Again, you have to identify pullback end in here. And not only we have end up pullback here, we also have to get inside this time frame and this candles and find pullbacks there and try to hunt this leg down. And you have to expect your risk to reward based on the candles, bigger candle size, or these swings. You cannot just put your stop here and want to just get 1 to 2 out of it. So you have to just consider which swings are you trading, what is your trading time frame. So here, if you go down and the only thing you're looking for here is sell, and again in this phase, it is kind of, again, if you go to the lower time frame, we have different kinds of market cycle. Actually, you're going to trade market cycle inside market cycle, and the last leg of your pattern or a structured time frame is your lower time frames market cycle. So now, as far as you are going down here, you cannot sell, you cannot buy because we still are in bearish trend. So here we're looking for finding end of pullback, and here again, after finding end up pullback, again, we have pullback here. These are low probability trading areas to buy. But if it is continuing like this one, and you are almost sure after retesting a higher time frame tension area, it is bouncing up and it's going up, you can trade and you can buy here while you cannot buy here. Why? This tension in front of this time frame is a critical point that you have to bear in mind. So that's why you have to just look at the context where the price is located. So now again, if you buy here for short period and one-to-one risk to reward, you will be having, if you can actually, you will have a winning trade again here, unless it is getting clear. So you cannot get inside the trade, and you should not have FOMO, fear of missing out. If you have fear of missing out, you're just going to have fear of actually losing, fear of failure, and the fear of even success. Okay, the starting point of everything in trading is fear of missing out, while you just need one trade, one good trade a day, and that's all. If you have one trade, is better than having bad trades. So you don't need to uh, trade every single move up and down. Okay, you can do one trade a day and dump for the day and run away. Okay, so one trade and you're done and you run away. You have to learn how to sit on your hands. This is the only way that you can be profitable. The only secret to be profitable is just sitting on your hands, nothing else. Because at the end of the day, if you have any kind of problems, psychological problems, so you have to just, if you have random trading, you're entering early or you're entering late, and to just fixing that stuff to be able to control outcome, which is out of our control in trading. You are trying to move your stop away, or you're going to add to your losing trades, and all of these matters start from random trading. And this random trading comes from fear of missing out. You're outside of trading world problems like you need money and this kind of stuff. So then here, as you see, we continue, and here we will stop. This is the hardest part in trading. Stop trading to earn money. Stop trading to become successful in trading. This is the only way. So here again, the very start of the leg is very risky. Okay, unless everything is cleared for you that okay, that's the end of this leg and I'm going to take the trade here. Okay, again here you're not supposed to trade tops and bottoms of it actually leg. So the only safe and the only place that you need to look for trade is in the core of the leg, this core of the leg, this core of the leg, and even here, core of the leg. Let the beginning and the end of the session be for the aggressive traders. So you just need one trade a day, and you can multiply it with different accounts. So you could just have one trade, but it is multiplied by 30 accounts or 10 accounts or whatsoever. So compounding effect comes from compounding your numbers of actually accounts, not your actually number of trade on one account. So then here again, we have this happy bee. So you know that this is a pullback, starting of the pullback in higher time frame, and you can see it in the lower time frame here as well. End up pullback here, you saw, and after end up pullback, you can just look for sell again. So here again, a valid low, because we have the close of the market, the close of the candle that broke the high of this previous candle. So, and also here we have the close of the candle which breaks the prior candle's wick, and you're looking for sell. Again here, pullback and valid high, sorry, valid low, and end up pullback, valid high. When you have valid high here and valid low, it means that the break happens by close of the candle. Okay, so here again, valid low. Here it confirms that it is valid low, and after this we have a structure shift, and you can look for buy. So yeah, you looked at it. So I'm just skipping this one. I'm going to give you another example here. I'm not going to explain it too into the details. So here, when we're going from, we have a bullish leg. So we're comparing the low of the candles. So the low of this candle is higher than the previous one, and this one is higher than the other one. This one is higher, this one is higher, this one is higher, and this one is higher, but it is broken by this bearish one. So when we have a break of previous candles low, we're starting to immediately count and compare the highs. So as I said, if the we have break of the low, we're gonna compare highs. If we have break of the high, we're gonna compare lows. So as you see here, we have break of the high, and we're gonna compare immediately those of these candles to see our legs. So now again, with a slight bit of move, we have break at the low. That's why we're going to compare highs, and again high, high, and it is broken. But the way we are breaking the candles defines our pullback end, or if we have at the same time pullback end and valid high or valid low. So then we have the close of the candle here that breaks the high, and also this one. Although we have three conditions for valid high and valid low, two of them are the same here. The last one, but the very first one is break out the low of the candle, which has the high, close higher than the previous one. So if you don't know that, you have to go back to the lesson. I think it is just a 10 to 15 minutes lesson. So go there and have a look at that. So here again, we have the low break. Now we're comparing the highs. Here we have break, comparing the high, break, comparing the lows, break, comparing the lows again, and it goes on and on like this one. So you can do it again. You can take a screenshot and exercise. Do as this one as an exercise. So I'm going to upload your exercises later in a couple of weeks. So, and you will have full access to the exercises, and I will explain the answers for the drills and exercises that you will master everything you are learning here. So here, if we put the end up pullback, it is end up pullback, pullback end. So here again, pullback starts again, pullback end, again, start of it, and it goes on and on like this one. So sometimes we have a lot of pullback and pullback ends here, as you see here. Okay, these are too much noise for our mind to process. That's why we prefer to go with valid low and valid high wave, and rather than just going through Gann system. So if you look at this one is Gann way of counting it, but this valid high and lows here are not considering these. You can see these ones are all filtered. So valid high and low gives us this. This is Gann leg. You see this one, yeah. This one is valid high and low. This will be valid high and low. This one is much smoother, and you can compare this one. I'm going forward and backwards. You can compare these two. So here we have one move, second move, third, fourth, five, and six. But in the previous one, we have a lot of noises. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and it goes on. Okay, so that's why you're better just wait and find actually the places that they are smooth and they're really clear for you to just trade. As I said, you just need one trade a day, not more than one. So here we go again. If we compare valid high and valid low legs with Gann legs, you can see this red one is valid high and low, and the black one is Gann way up, looking at the pullbacks and swings. So here, as you see, the market cycle for this one is sideways. So though we had some legs here, we can break this one into lower time frame, and we will have uh, uptrend here, which could be a channel. Okay, so here again, this one, it depends on the time frame you're trading and your commissions and your personal preference, and if you have enough time to just process this old stuff. So here you're looking for sell, here you're looking for buy. It depends where your stop and your target goes and what your risk to reward is. So how many pips you want to just take out of this trade, and how many pips you want to just put as a risk, and how much you want to risk for the trade. So now, if you look at multi-time frame valid high and low legs, this is the way it looks like. Okay, so if this is 15 seconds time frame, this black one is 1 minute time frames swings, and this green one is 5 minutes time frame swings, and this blue one is 15 minutes time frame swings. As you see that the lower time frame, this is the black ones, okay, delivers the mission that the higher time frame has. They're just doing the agenda, everything which is supposed to done by higher time frame. So here, that's why when you have the bias, which is green, and here also blue one, okay, so, we're going to talk about the time frame matching, okay? Sometimes your 1 minute time frame matches with 5 minutes, and sometimes it is matching with 15 minutes. So it depends on the momentum and the market cycles strengths and legs strengths. Okay, for example, here your 15 minutes cycle, 15 minutes last leg, if it was not here in this part, okay, it was matching with 1 minute or even 15 seconds swings, okay, because this is so strong. So the further it goes away, so it goes, I mean, the distance between time frame will be this. Actually, I want to just rephrase it like this: if the momentum is very very high, so yeah, the distance between your structured time frame and trading time frame will be more and more. Like your 15 minutes will match with your 15 seconds time frame. Sometimes your 15 minutes matches with 1 minute time frame. So that's why you need to plot these things on your chart. So after you plot these things, the first step is defining your market cycle. The second step after, as I said, market cycle is a market structure plus momentum. Later, afterwards, you're going to break it down into trading time frame, and you're going to find a trading zone. And later, you find some scenarios to go to find entry points in the zones. So another one, just if you just compare, just Gann way out the same thing. Look at this one. This one is, let me go backwards. So here we have multi-time frame using valid high and low, which is smoother. This one is the same thing, but using Gann, which has more noise. So it is better to avoid this one unless you are just going to have some pips here and there. So again, multi-time frame of this, we compare these two together. So the same stuff. So now I think for today's session, it is enough. Take good care and see you in the next one.